revolution. There's a revolution in the capital markets going on. And that revolution is impacting the capital markets for currency globally. It's impacting the capital markets for equity. It's impacting the capital markets for credit. It's impacting the derivatives capital markets. And the basis of a lot of this starts with Bitcoin. And it starts with the embrace of Bitcoin by the global financial community. So Bitcoin is emerging as digital capital. And why is it digital capital? Because the President of the United States, Donald Trump, has styled himself the Bitcoin president. He's declared he wants to make the United States the crypto capital of the world. He's decided he wants to lead in digital innovation, whether it's digital assets, digital capital, digital finance, or digital intelligence. And you can see that it's not just rhetoric, because he's appointed a cabinet, and that cabinet consists of an incredible array of digital advocates. The Vice President of the United States is an advocate. The Secretary of the Treasury, Scott Bessent, is an advocate. The head of the SEC, Paul Atkins, is an advocate. And not just the financial regulators, you also have non-financial regulators like Tulsi Gabbard, Kelly Loeffler, Robert F. Kennedy, even the head of the FBI or the head of Commerce. You've got an unprecedented support for this asset class across those people running the entire government of the United States. And this is a big deal. We've come a long way in 12 months. The second thing that's happening is that for Bitcoin to emerge as digital capital, you need the banking industry of the world and the banking establishment to embrace it. And they were fairly hostile to the entire crypto industry until about a year ago. And even a year ago, with the change in administration, there was uncertainty as to whether or not the banking regulators would actually make good on the campaign promises of the Trump campaign. And what we've seen is they have. There's been a series of announcements by Treasury, by the OCC, by the FDIC, by the Federal Reserve, and even joint bulletins from all those financial regulators. The sum total of them to say crypto is good, Bitcoin is good, it's okay to bank it, it's okay to lend against it, it's okay to custody it. We know that the previous administration punished banks that engaged in crypto activities. We're not like them. There's a 180-degree sea change. So banks are the most bureaucratic, risk-averse institutions in the world for good reason. You would think that from the point that the tone at the top changed 180 degrees, it might take a bit of time. I mean, for all the banks in the world to embrace crypto, to embrace Bitcoin, in 4 to 8 years would be fast. What you see here is it's happening much faster. What we've seen is BNY Mellon, PNC Bank, Citibank, JP Morgan, Wells Fargo, Bank of America, Vanguard, all of these have flipped from a hostile, negative, or skeptical view to a positive view in the last 12 months, right? We have announcements. Schwab is going to custody Bitcoin and extend credit against crypto assets early next year. Citi is doing the same thing. It used to be, I couldn't get a loan against Bitcoin from any major bank, and now if I counted the top 10 banks in the United States, 8 of them are actually engaged in crypto lending, and they've all flipped their stance in the last 6 months. So this is a major change. Wall Street's embraced Bitcoin as collateral, as capital. We were the first company that was publicly traded with a substantial holding of any crypto asset, and the first company with Bitcoin on the balance sheet. Then there were a dozen, and then there were 2 dozen, and then there were 60, and now there's a lot more than that. When we started doing it, there were no ETFs. And you can see that the first ETF was approved January of 2024. There's 85 worldwide. And of course, the most successful ETF in the history of the world is BlackRock's IBIT ETF. So you can see that Bitcoin has exploded through all of the fund business. It has exploded and been embraced through hundreds of publicly traded companies. I mean, to think we've gone from just a handful to more than 200 in 12 months is just an extraordinary move. Bitcoin is the economic foundation, the ethical foundation, and the technical foundation of this entire market. If you consider why, it's because it has the most power. It has the most electrical power, 24 gigawatts. That's 24 full-on nuclear reactors. That's more energy than drives the US Navy. It has more computer power, more than 1,000 exahash. That's more power than all the data centers that Microsoft and Google could muster together. It's got more trading power. There are 1,000 exchanges. Anybody can trade this anywhere in the world. Anybody can custody this anywhere in the world. Anybody can transfer this asset anywhere in the world. It's got more political power, right? We've got hundreds of millions of crypto enthusiasts. We've got hundreds of millions of Bitcoin holders. 30% of the registered voters in the United States are pro-crypto. It's got more economic power. More than $1 trillion has been invested in this network. $1 trillion of real capital. My company has spent something like $48 billion to acquire 3.1%. And so if you basically take 3.1% to a 48 billion and you scale that out, you see how much real money is flowing into this network. So the first big idea is you now have digital capital, a store of value. But that's just the beginning. That is the basis of an entire digital finance and digital credit industry. And all of these companies capitalizing on this can do lots of different things. You can rethink insurance, you can rethink banking, you can rethink trading, you can rethink all sorts of finance. We have focused upon rethinking credit, and so we are the first digital treasury company. What do? We created a capital balance, about 650,000 Bitcoin as of now, and we've acquired that consistently over the past 5 years. We're acquiring a huge amount of capital because we want to use it to create an extraordinary new kind of credit. Right now, we're the 5th largest treasury in the S&P 500. We're climbing our way. I think we'll be number 2 in the next couple of years. And in 4 to 8 years, we expect to be number 1. And we're doing that because we are positively polarized to capital. If you look at this chart tells a story, which is every company on Earth, if it's conventional, is capitalized on money markets. The money markets return about 3% a year. That's the conventional finance strategy. But if you were to capitalize on Bitcoin, you'd be returning 47% a year. It doesn't take a rocket scientist to see that if the cost of capital or the hurdle rate is 14%, that's the S&P index, then any company capitalized on money markets is destroying shareholder value as they accumulate capital. But any company capitalized on Bitcoin is increasing or creating shareholder value. So when I say we're positively polarized, what I mean is every company that capitalizes on digital capital can raise more money and get more powerful forever. And they're competing against companies that are capitalized on fiat currency or conventional money markets that are getting weaker the more capital they carry on their balance sheet. So conventional wisdom is decapitalizing companies Digital wisdom is recapitalizing companies. The secret to our success is we simply raise capital at the cost of credit, 6 to 12%, or the cost of equity, 14%. And then we buy something appreciating 47%, and that's how you get to a 65% return. We raised $22 billion of capital last year. We've raised $22 billion of capital this year. And so all of that money is flowing into the crypto economy. And we have raised capital a variety of different ways. You can see it was $16 billion of equity last year and $13 billion of equity so far this year. But we're also drawing in capital via digital credit, about $7 billion of digital credit, these public instruments like Stripe, Strike, Stride, Stretch, etc., and then also traditional debt. This is a snapshot of our capital structure. Right now, about $60 billion of BTC reserves against about $8 billion in debt. So it's a fairly low leverage ratio. We have about 73 years worth of dividends. The company pays out $800 million of dividends a year. For us to pay that money forever and grow shareholder value, Bitcoin would have to appreciate 1.36% a year. That's the cruise speed. So when you think about what our bet is that Bitcoin will appreciate more than 1.36% a year. If it does, we win. It's just that, by the way, the equity wins. If it doesn't, then the equity isn't a good investment. What we did this week was we raised a $1.44 billion US dollar reserve, and that gives us 21 months of dividends. We did that so that we could pay the dividends without selling equity or BTC derivatives or BTC if none of those capital markets were open to us. You could think of it as we can hold our breath for 21 months. Like if the market is irrational or closed for 21 months, we can just pay out of this reserve. It's like a battery. And so the company's strategy is when our equity is trading above the net asset value of the Bitcoin, we just sell the equity. It creates shareholder value. And when the equity is trading below the value of the Bitcoin, we would either sell Bitcoin derivatives or we would just sell the Bitcoin. You could think of it as, here you have a spaceship. What is our goal? Our goal, by the way, is to create the best digital credit. Our goal is to provide you with a bank account that pays you 10% instead of your bank that pays you 4 or 3 or 2 or 0. That's what STRC is. So that's our goal. The way we do it is we have a Bitcoin reactor, a crypto reactor in the middle of the company. It's charging a battery. The battery is a US dollar battery. The battery is for short term. The reactor should, presumably, if Bitcoin appreciates 1.3% a year, the battery runs forever. Or the crypto reactor runs forever, right? If Bitcoin appreciates 0, then the reactor runs for 73 years. And then we just fuel the entire machine either in the equity capital markets or the BTC market or the BTC derivatives market.